Love the payment before you love the house. What's going on, guys? My name is Minh with What's a Mortgage. Welcome to our channel. The goal of our channel is to educate, empower, and to connect you with the right mortgage. If it's your first time tuning in to What's a Mortgage, hi again. My name is Minh Nguyen. I've been a mortgage banker since 2003. If it's your first time tuning in, please subscribe. Hit the notification button so you're notified every time we go live or post new content. We go live Mondays and Wednesdays on Facebook and YouTube, and I go live Tuesdays on Instagram. And we post our videos Sunday mornings and Wednesday mornings. All right, guys, hopefully you're having a great night. Also, this is an interactive live stream. So if you have questions regarding home ownership, tonight's the night to ask. I know a lot of you guys are getting confused or you're nervous. Hey, should I do this? Should I not do it? I want answers, and I don't know where to find it. And I want answers, but I want answers without someone trying to sell me, pitch me, or pressure me to running credit. You found the right place. We're not here to pressure you, push you, but we're here to give you certainty in the biggest investment you're gonna have in your life. That's my opening. We're working on it. Tonight, guys, we're gonna go over, should you finance closing costs or not? Should you do down payment assistance or not? When is a good time to do down payment assistance? When is it not a good time to do down payment assistance, right? So definitely not, guys, tonight we are gonna show you, we're gonna show you a tool that we're using thanks to James Williams, who is the Techylender. We're gonna go through the Techylender Calculator together so you can use the Techylender Calculator and figure out, should you finance closing costs or should you not finance closing costs? All right, guys? Also, you have questions that are not closing cost related, it's okay. But I will answer all those questions after I go over, should you not finance closing costs or not? All right, guys? Let's get into it. So, the most important thing, to run the numbers, you need the right calculator. You guys hear me say it all the time. Run the numbers, run the numbers, run the numbers. You can't run the numbers without the right calculator. You can't run the numbers without the right interest rates. You can't run the numbers without the right effective rate, right? The right tax rate, the right hazard insurance rate, right? So we need these rates. Well, where do you find them? Trust me, I've been on tons of other calculators and I cannot seem to find the right one. That's why James Williams, right, the Techylender, built out a calculator to make sure you guys can figure out the payment and have a more exact number. The last thing you want to do, get excited. You use a Zillow calculator, Redfin calculator, NerdWallet, bank rate calculator, or mortgagecalculator.org, and the payment's not there, right? So we're going to show you how to use the right calculator to make sure you know how to calculate your payment and figure out, should you finance closing costs or not, all right? Let's get to our calculator here. Right? This is Techylender Calculator. Go to techylender.com. Techy lender.com. So if you're on a computer or if you can do multiple screens, go to Techylender Calculator. Okay? So once you're on the Techylender Calculator, right? Start calculating. You go here, you hit yes, and here we go. Right? So now we're on the Techylender Calculator. So the next step that you've been on the Techylender Calculator, if it's your first time using it, we have other tutorials on that, but I want to scroll down first for tonight's demonstration. Is we want to make sure this scenario comparison is on, right? We can turn off all the other ones, but make sure the scenario comparison is on. With the scenario comparison, now we can compare what should you do, okay? We'll have the comparison, and also it'll tell you what the payment of the comparison, the difference is, okay? So now let's scroll to the top, right? So a lot of people ask me all the time, should I do down payment assistance or should I not? Man, rates are so high on down payment assistance. Why would I do down payment assistance, right? End of the day, only you know you. Everyone is in a different position. I was talking to this lady today, and I went over with her the mortgage payment and how much her out-of-pocket was. And in my mind, I'm thinking people who are buying their first home are trying to be frugal and save cash out of pocket. She was like, I'd rather come in with a bigger down payment and save that monthly payment, right? So everyone's different. In my mind, thinking, okay, I take the higher payment because I want all my cash now, right? She was like, I'd rather come out of pocket more and pay less. Everybody's different. All right, so let's check it out here. So let's go when we're looking at down payment assistance, we're gonna look at her scenario, okay? So I'm not gonna say her name, right? We go first to CalHFA rates, right? If you're doing down payment assistance right now, of course, there's other programs out there. Tonight, I'm just showing examples of CalHFA, okay? So her purchase price is $350. She has a I think she said 780 credit score. So we go here, right? Let's explain first. So the first CalHFA right here, right? The first one right here, 2.75. That's just the loan, and you're not getting down payment assistance. Why would you even get that? CalHFA also offers loans without down payment assistance, right? Here's the 2.875. That gives you just the down payment and not closing costs. Here is the 2% zip, which will give you 2% towards closing costs, right? Here's the 3% zip, which is 3.5% is the interest rate, which will give you 3% towards closing costs. So when you're doing down payment assistance, remember, there's always an origination charge between 1.5% to 2%. Okay, so that's why sometimes when you do buy with a CalHFA loan, you will come out of pocket. Typically the out of pocket is about 2% of the purchase price. But there's also a caveat. CalHFA will loan you up to $10,000 for closing costs. So if you go over $10,000 on top of the 2% towards closing costs, you got to come out of pocket the difference of above $10,000. For example, if she's buying for $350, right? And she's doing 3% down, let's go here, 350 times 3%. So the down payment is $10,500. So she would have to pay an additional $500 for this loan. Okay, so now we know that rates are 3.5, right? We're gonna go with a 3.5. Let's punch in the numbers. Okay, so if she's buying 350, conventional primary, county doesn't really matter because it's 350, right? 350. Okay, the interest rate is 3.5%, which we put right here, right? 3.5%. The term is 30-year fixed. The down payment, even though it's down payment assistance, she's going with the conventional version, which is 3% down. So if you're doing down payment assistance, you're either doing the FHA version or the conventional version. So for the down payment, it's typically going to be either 3% down or 3.5% down, okay? So 3% down, her down payment is $10,500. Her loan amount is $339,500. Her LTV, her loan to value, is 97% since she's using 3% down, okay? So hazard insurance right here, we have that automated. I've looked through other mortgage calculators. They don't have the correct hazard insurance rate and formula to calculate your hazard insurance. Guess what? Here at What's a Mortgage, we do. We're using the rate the underwriters use when they're trying to do underwritten approvals, which means they have not found a property, but that lender provides underwritten approvals, which means the loan can go into underwriting right away. And because there's no hazard insurance quote yet, they're going based on the purchase price and the down payment. Okay, so it's $50 a month. Okay, her property taxes, right? And that's one other thing that we did on Techylender that they don't provide on other calculators, right? The correct property taxes. If you're buying a home and you don't know what property taxes are, the lenders typically use 1.25%. Unless you call the county and you tell them, I'm buying in this city, then they'll give you a tax rate. Once they do that, all you gotta do is click this from yes to no, right? And put in your tax rate, okay? So now we do 1.25, it's $364, all right? So we have a tax of $364. Let's look at her PMI, right? So she had a 780 FICO, 3% down. So at 3% down, 780, it would cost her 0.58 minus, right? Minus, there's only one person on the loan, okay? If there was more than one, I can subtract 0.13, but there's only one person on the loan, I can't subtract it. So it's 0.58, okay? So now we know the conventional tax rate, okay? If you want to understand how to read this more, you can scroll down, right? And we give a tutorial on how to understand conventional tax rate. But we know it's 0.58. So if we know it's 0.58, we can go here, punch in 0.58. So we know her conventional PMI, all right? So guys, definitely, are you guys following along here? So now we know that her payment on 350 is going to be 2103. Okay, 2103. That's with her coming out of pocket about 7,000. Remember, like I said, when you're doing down payment assistance, since it's 350, right? She went over the 10,000. So she's going to come out of pocket $500 on top of the 2%, right? So that will be 7,500. So you have a choice now is, yes, you will owe more because you're financing the down payment, the closing costs and the down payment. You're going to come out of pocket $7,500, but your payment is $2,103. Okay, guys, once I give you this answer, let me know, what would you rather do? Would you rather do down payment assistance? If you would rather do down payment assistance, put DPA. If you'd rather just pay your own fee, just say pay my own. Okay, here we go. Let's do a census, right? So 2103. 2103. So we hit scenario comparison. Thank you, JD, right? It's comparing scenarios. It's not lender paid. Today's interest rate. If today's interest rate, you paid your own down payment and your own closing costs. So on a $350,000 loan amount, you're going to pay about 6.5% total for down payment closing costs, $22,750. Okay. So ask yourself this, my friends. Would you rather come out of pocket? So here's rates 2.625, right? The payment's $1942. So would you rather pay $2103 and come out of pocket $7,500, or would you rather pay $1942 and come out of pocket $22,750? $22,750 minus the $7,500 that you would come out of pocket, that's a $15,000 difference. Let's say that $15,000 difference. This lady who I talked to, she'd rather just pay the $22,750, right? So the saving difference, and you can see here in our calculator, is $160 a month. Annually, that's $1,900 in 5 years, right? She would spend, if you're paying for if you're financing the closing costs in 5 years, you're overpaying only $9,654. So in 5 years, you haven't recouped your money yet, right? So here, $15,000, right? So you would have to be in year 7 or 8. So you would have to keep this loan for 7 or 8 years to spend more than you would if you came out of pocket. So that's why sometimes, guys, I want you to understand, it all depends on what you want. But for me, I thought about, hey, I'd rather come out of pocket $7,500. Did you know the average American only keeps their loan for 3 to 5 years? So if you kept this loan for only 3 to 5 years, you'd actually save money doing down payment assistance, even though you're paying $160 more. By the way, if she went with a conventional loan, right? So if she went with a conventional loan, her PMI is $164. After 5 years, the $164 falls off. She's actually her payment will probably be like $1,800, a little bit over $1,800, right? So guys, remember that. So even though she'll save more on the conventional, but you got to keep that loan for a long period of time. Only you know, right, what you need. Hello, Kitya. Down payment says, because I'm going to refi after a couple years. That's right. A lot of people can refi a couple years. Once you have enough equity, you could pay off that down payment assistance. Okay? So guys, so that's why when I talk to you guys, well, you know, would I do a down payment assistance? The rates are higher. Yes. If you go with a down payment, the interest rate is 2.625, right? You're going to cover your own down payment closing costs. It's 3.5 when you don't. But when the purchase prices are under 400, 450, which I tell you guys, right? It's cheaper to go that route than to unload all your money on down payment, unload all your money on closing costs. Like I said, the difference was $15,000. So let's say, remember guys, we were talking about the savings, right? The savings is, I think, $160. If you took your $15,000, it's better that you pay off all your other debts. Or you save that $15,000, right? And you pay for your washer and dryer cash. You pay for your microwave cash. You pay for your oven cash, your refrigerator, right? I see people run into this issue all the time. They unload all their money towards down payment, all their money towards closing costs, and they go out and they finance their washer and dryer, their kitchen, other appliances at a 24% interest rate, which is going to be more than $160 a month. So guys, sometimes it's worth running the numbers, and that's why it's so important, right? There could be opportunities where it's not worth it to, finance it. But in this opportunity on down payment assistance, it was well worth it to me. But to this lady who I just spoke with her an hour ago, she'd rather pay the $22,000 and save $200 a month. She says she will never leave this house. She will never refinance it. So I told her, if you're never going to refi, then go that route. Everybody's different. All right, guys. So make sure you're working with the right lender to run the numbers, right? So a lot of lenders, if they know you have a down payment, when I hear that someone has a down payment and the purchase price is under $400, I always give them the opportunity to look at down payment assistance. It might not be for them, but when you see the numbers for yourself and to see what situation, what opportunity you're in, then you can make the right decision. But I hate it when loan officers just want to go FHA, just want to go FHA, just want to go FHA, right? So that's why I don't like it. So, all right, G. Dulcide, grants. Grants right now, your out of pocket is about 3 to 5%, 3 to 4%. If you're going to come out of pocket 3 to 4%, might as well go with an FHA, might as well go with a conventional, right? So that's what I'll even pull it up. Gee, anyone want to see grants? Before we'll do grants, right? Since G asked, I'll do grants. Today is your lucky day, G. I will do grants for you today, right? GSFA platinum rates. Here we go. Let's do this, right? Let's do it, right? Let's go to GSFA platinum. Let's go to GSFA platinum rates. Okay. G, if we're looking at the grants, right? Grants mean the money's forgiven. Either the money's forgiven right away if you're in first responder, police department, fire department, teacher, right? Medical field, right? It's forgiven right away. But what's the cost still? End of the day, net, what is the cost of out of pocket? Okay. So, and then the second thing is if you're not in that position, right? The money's forgiven after 3 years. So here we go. Here's the Jenny Mae version, right? If you're borrowing 0% of the money, 2%, 3%, 4%, 5%. So just to let you know, no matter what you borrow, the lender's still going to charge you 1.5% origination. So if you borrow 3%, it's going to cost you 1.5. You borrow 2.6, 4%, they're going to charge you 1.5. Right? So you might as well take the 5%. So see that 3 1/8? 3 1/8. Okay? So when you're doing GSFA, right? Let's say you take that 3 1/8. Okay, let's go here. Let's go that 3 1/8 here, right? Let's go with that 3 1/8. 3 purchase price, 500. Let's go with FHA. All right, 350. Interest rate, 3 1/8. You guys get this? Are you guys following along here? Down payment 3.5. Even though it's down payment and it's a grant, you got to do 3.5, right? So 3.5. All the PMIs calculated for us right here. Your payment will be $21.23. But no one tells you this about the GSFA, right? So the GSFA gives you 5%, 3.5 towards down payment. The other 1.5 pays the lender's origination. They didn't tell you there's still title, escrow, impounds. So if they're only giving you 5% as your gift or your grant, you still got to come out of pocket 3%. Okay? So if you come out of pocket 3%, right, to 3.5%, let's say 3.5%, right, because of impounds, might as well go with an FHA loan. So right now, if you went FHA and you got all your closing costs covered, you're paying the same thing. So right now, actually, you're paying less. So if you come out of pocket, right, if you do FHA versus CalHF, the grant, you're going to come out of pocket 3% or 3.5%, the other one 3%. It's the same amount out of pocket, right? But the difference payment is $23. If you do a down payment on FHA right now and you took a 3% rate, you came out of pocket 3.5%, your payment's $2,100. If you do the grant, your payment's $2,123, right? So if you're considering doing down payment assistance, you got to run the numbers to see what is your out of pocket and is it worth it or is it not worth it, okay? So definitely, that's what I would do. I would run the numbers and find out if it's worth it or not. I do not work for Cal HFA. I don't work for any other down payment assistance, so I'm not trying to talk bad on GSFA. I'm just letting you know we run the numbers every day. And right now on GSFA, your out of pocket is between 3 to 3.5%. I've talked to so many people that another lender talked about GSFA and still gave it to them. End of the day, that lender just gave them what they wanted, but didn't look at what is their out of pocket. If they're going to come out of pocket that amount of money, right, they should tell them, hey, you might not want to do this. So what happens if you're doing GSFA and you don't get your money's not forgiven for 3 years? That means you can't refinance that loan for 3 years. You're stuck paying that loan for 3 years and you can't refinance. And of course, if the grant's forgiven, right, you could refinance right away after 6 payments, right? You can do an FHA streamline. Okay, so hopefully that helps you guys out. If you even look at the conventional version here, let me break this down to you one more time, right? The conventional version. I have not seen anyone who's going conventional, right? If you're below 80% AMI, the area medium income, right? If you're going conventional, that means you have good credit. People with good credit will not be below the AMI. There are people who are, but very rare, right? If they have good credit, they'll be above AMI. There's a reason why they got good credit, because they're making more than enough money to pay their debts. So think about this. If you're borrowing 1% down, 3.25%, you're borrowing 2%, 4%, 4% interest rate. If you borrow 3%, it's going to cost, the rate's 4.5%. The lender still has to charge you 1.5% origination. That does not make any sense. All right, guys? So, if you do feel like some of you guys might disagree with me, let's run the numbers and find out, right? You're over AMI. Of course, Kitty, you make too much money, right? So that's one way for you to see, should you finance closing costs or not, all right? So look at another scenario, okay? Let's look at a regular 5% down conventional, okay? So let's go up here. Let's go with a conventional 5% down, right? Let's go with 500,000. So we increase the purchase price. So when the purchase price gets bigger, right, financing closing costs gets a little more expensive, right? The gap starts spreading further. That's why I like, if you're buying a house under 400, under 450, I like financing closing costs, because you see the difference of payment is not too big of a shock. Let's see how it is at 500,000, okay? 500,000, conventional, right? Today, if you paid your own closing costs, your rate would be 2.625. That's with good credit. You went 5% down. Okay. The hazard insurance are already calculated. The tax calculated. Let's double check the PMI. Let's say you have a 740 FICO score, right? You'd be at 0.53. You have 2 borrowers on the loan, right? So it's 0.09. You get to subtract. So 0.53. So I'll be 0.44. Everyone get that? So if you go with the 5% down, you see, right, at 740 credit score, it's 0.53 right here, right? And then also you get an additional subtraction at 740 because you have 2 borrowers, 0.09. So 0.553 minus 0.09 is 0.44. Does everyone get that? Okay, let's get back here really quick. So 0.44. I'm sorry, it wasn't 0.43. So payment, right, on 500,000, 5% down with a rate of 2.625. The payment is 2665. 2665, okay? So if you decide you want to go with, with the lender covering closing costs, right? This is where you're at, $2,857. So you can either pay your own closing costs. So on a $500,000 purchase, let me double check here, you're gonna come out of pocket 25 grand. Would you rather, let's make it worst case 3.5, right? Worst case 3.5, right? Would you rather come out of pocket 5% down and use $10,000 to cover your closing costs? So you would come out of pocket around $35,000. Would you rather come out of pocket? Guys, let me know. do assistance or no assistance, right? On a $500,000 purchase, would you rather pay $2,665 and come $35,000 out of pocket, or would you rather pay $2,890 and come out of pocket $25,000? That's $10,000 difference. Okay, so if you're looking at $10,000, let's say I take that back, 12,500. Closing costs on 500 grand is about 2.5%. So 2.5%. Let me see here. 1 second, guys. 500,000 times 7.5% is, so you can, so if you take the 2.625 where your payment is $2,665, your total out of pocket is $37,500. Would you rather take the $37,500, right, or and pay $2,665, or would you rather take the $500,000, come out of pocket $25,000? The difference of payment is $2,890, right? So $37,500 minus 25 grand is $12,000. So you see right here, it took to almost year 5 for you to pay more. So like I said, when the loan amount gets bigger, things change, right? So you got to ask yourself, is it worth financing closing costs, right? You can take that $12,500 and pay off other debts and save more than $225 a month, okay? Once you make your 6 payments, if rates are good, you can refinance and lower your rate. It's almost like taking money from the bank, okay? So you have a choice, $2,890 and come out of pocket 25 grand, or $2,665 and pay $37,500. Everybody's different, but now you know the numbers, so you can decide, should you finance closing costs or should you not, right? Some people, they don't have that extra $12,500. Let's say you have your down payment and you're wrestling to save $1,000 a month for 12 months to have your closing costs, right? Sorry, Ruben. So think about this, right? So some people, think about this. You're gonna save $1,000 a month for 12 months instead of paying an extra $225 a month. Some people don't have their closing costs yet. Some people just have their down payment, right? So would you rather, right? Ask yourself this. Would you rather, that's totally my situation. Would you rather pay the $37,500, right? Or would you rather pay the $25,000? The difference of payment is $225. Some of us, we don't have the extra $12,500, right? Or what should you do? Should you wait another 12 months and save $1,000 a month more to save $225 a month? On a $500,000 home, by the way, if you wait 1 year to buy it to save your closing costs, you're really gonna pay $520 for that house, because homes appreciate averaging in California 4% a year. So every year you're saving, if you can't even save $1,000, say it takes you 2 years, it's gonna go up 20 grand almost every year, right? So you gotta ask yourself, right? Should you use your 401k? Should you come out of pocket? Only you know what's best for you. Like I said, my job is not to convince you about home ownership. My job is to present all the numbers so you can make the best decision for you and your family. Okay, guys? So we are going to go over one more demonstration today for Jane P. All right, Jane P. Let's go Jane P here. Jane P, are we going conventional? What are we doing? 5% down, 10% down? How's the credit, Jane? Let me know. As I'm typing this up, Jane, I need you to respond. Guys, if you have questions, start asking. And what I'm going to do is I'm going to go back and answer all your questions. But let me take care of Jane here, guys. I would do the same for you. GSFA, there's a max loan amount. It's going to be $540. All right. Zode Mora, with the GSFA, with these grants, they're capping at the conforming loan limits. What's the down payment, Jane? Let's go to Jane here. 600 grand. 600 grand. What are you doing here, Jane? I need to know down payment, girl. All these people are waiting to go through their scenario, ask questions. Jane, I need a 5% down. Okay, conventional, 5% down, right? The rate's 2 point, actually, yeah, I'm gonna give you a 2.5 just because I like you, okay? 2.5, 30-year fixed, 5% down. Your down payment is $30,000, right? Everything else preset. Let's keep your PMI. What was your FICO score again? Your FICO score was 780. Let's check out 780. 780 5% down is 0.30. Jane, is there more than two people? Let's assume there's two people on the loan. Jane, is there two people on the loan? If there is, it's 3.3, 30, it's 30. You get to minus 0.9, which will be 0.21. Okay, so 0.21. 0.21. So you have a choice. Your payment's $3,051.94. Yes, I do, X Maroons. So Jane, would you rather pay $3,051.94, right, a month, but you're gonna come out of pocket about $42,000, right? Your down payment, which is 30 grand, and then the rest for closing costs, right? About 12 grand for closing costs, okay? Would you rather, or Jane, would you rather make a payment of $33.19 and just come out of pocket $30,000? Only you know. Is that okay, Miraz, that I worked at Loan Depot? So the difference is $267, right? So annually, it's $3,200 more you're gonna spend a year, right? In 5 years, you're gonna spend 16 grand. Guys, that's why I love this calculator. It will show you a comparison should you finance closing costs or not, right? Everything I'm telling you guys that I wanted in a calculator when I'm on the road, right? We haven't even gone over the qualifier, right? We're gonna use this calculator, showing you how to calculate your mortgage payment. All right, guys? So guys, let's go some Q&A here. If you have questions, I got answers. Guys, if I brought you value tonight, do me a favor, especially you, Jane, hit the like button on this video. Also, please share this video with anyone you know that's about to enter into home ownership, right? If your spouse or whoever you're buying with is not sitting there with you, tag them on this video. All right, guys? Remember, and subscribe to our YouTube channel. If you haven't subscribed yet, hit that subscribe button. All right, guys? Let's scroll up here. Some Q&A. Quilla from YouTube. When are you able to refinance? After you pay down to a certain principal amount, after a certain amount of a time. So here's the answer, Jonathan. So when you buy a home, you cannot use new value to refinance for rate and term till after 6 months. For cash out, 12 months. Okay? So when you want to refinance, it's a balance of both. You need equity, though. That's the most important part of refinancing. So either as time ages, you get more equity. With more equity, you can refinance. Or if you pay down your house to a certain percentage, which gives you more equity, you can refinance, right? With refinancing, unless it's an FHA streamline or a VA IRRRL, when it's streamlined, there's no value needed. But for a regular refinance, especially if you're trying to go from FHA to conventional, or you're trying to pull cash out, you need equity. And in time, you have more equity. The more you pay down your house, the more equity you have. Typically, for rate and term, right, on a conventional, you'll need at least 3% equity, 5% equity, or more. If you're pulling cash out, you need at least 20% equity. They won't loan you past 80% loan to value. They want you to have 20% equity left. Okay, hopefully that answers your question on when you can refinance. Stephanie Silva, hi Minh, by financing closing costs, it means I pay it upfront with the down payment, correct? No. If you're financing closing costs, there's two ways. You either, let's say the seller wants to sell the house for $300,000, you offer $310,000 and you ask for $10,000 back for closing costs, so you're increasing the purchase price to finance closing costs. But remember, the house has to appraise and the seller has to agree to it. The second way to finance closing costs, that you're offering $300,000 because the seller's asking for $300,000, you're paying $300,000, but instead of taking the par rate or the base interest rate, you're taking a higher interest rate to finance your closing costs. So those are the two ways you finance closing costs. You never pay out of pocket up front. You either increase the purchase price or increase the interest rate. Hopefully that helps you out. Ruben Garcia from YouTube. If you owe the IRS money, will that stop you from owning a home? And the answer is no. As long as you show that you're making payments to the IRS, they just take that payment and they count it against your debt to income ratio. If what you owe is brand new, if you go FHA, they want the letter of the payment letter, and they want to see 3 payments. If you're going conventional, this is for new liens that just pop up, right? Or new liens that just showed up because you filed your taxes, right? If you're going conventional, they just want the payment letter. You do not need proof of 3 payments. But yes, you can buy a home if you owe the IRS money, as long as you are taking the payment and adding it to your DTI. Hopefully that helps you out. So definitely, guys, like if you have a loan estimate, you have questions about, hey, are you overpaying or not? Or, hey, I want to see more options, but my other lender's not giving me these options, definitely reach out, all right, guys? And we want to end all our episodes with our attitude is gratitude. Without you, there would be no us. So thank you so much. Guys, enjoy the night, and I will talk to you soon.